We want to bring in Troy Gayeski. He is FS Investments' Chief Market Strategist. Troy, we're going to join you at the desk here in just a minute. But first, just your take on some of that selling action that we've been seeing in the markets right now. Why shouldn't investors be too worried?
Well, big picture, right? What is driving the sell-off? It's stronger economic growth leading to stronger inflation, leading to bond market participants pushing back the expectation for Fed cuts, which were somewhat delusional to start with. So there's really nothing disastrous in terms of fundamentals. Earnings growth looks significantly powerful. However, higher yield should mean lower multiples, which is what we're seeing now.
I tried to remember that stat from FactSet off the top there, but I needed my paper to be able to reference exactly what they were laying out there, Troy. And kudos to you, too. Unfettered concentration as we were making our way over to the desk here as well here. You know, as we're thinking about this earnings season, what is one huge theme that you expect to emerge?
Well, I think it's divergence, right? So you think of a lot of the rebound from October 22 to really end of last year, very concentrated in Magnificent Seven. You know, every company, for the most part, Tesla maybe an exception, was doing very well. And this year you've seen much more significant divergence, right? Apple, which has obviously been a juggernaut, hasn't performed as well. Tesla's been a borderline train wreck. But and then on the other side, you have Nvidia just monetizing, you know, the AI boom, which is something we've never really seen. In history, there really hasn't been a company like Nvidia that has grown market cap so fast, but has grown earnings faster. Really, really remarkable. So the divergence, that's a healthy development for markets.
Should investors be looking at some of the selling that we were looking at last week and seeing that as a buying opportunity? When you take a look at overall the NASDAQ here coming off what was extremely terrible week here, worst week that we've seen in quite some time. Is that an entry point?
Yeah, I think you have to be a little careful in the short term because what's really driving markets, again, is the back end of the Treasury curve. And when you think of the limitless issuance that's going on, you think about the fact that inflation is persisting, it's very easy to imagine a 10-year breaching 5%. Remember, 5% was the limit we hit last year. So I think you want to be cautious in the short term. But when you look through the Magnificent Seven, you know, Nvidia is obviously a clear winner, Amazon, Microsoft. So if you missed the upside and you need to add more mega cap beta, that might be a good thing to start with. However, just be cautious, right? Because we could certainly fall another 5 to 10% in the NASDAQ here.
Interesting. Okay. And so how much of a catalyst, one way or the other, is the Fed and the decision making that comes now, not even just in June, but going into the third quarter of this year?
Yeah, so as usual, the Fed is the most powerful financial institution in the world, right? And you know, the interplay between Fed policy, money supply, Treasury valuations, always very critical. If the S&P was 16 times forward earnings, wouldn't matter as much. But we got back up to 21 times forward earnings, and even with strong earnings growth and a powerful economy, you can get multiple compression into elevated yields, which is exactly what we're seeing now.
So, Drew, what should investors then be doing if they need to be cautious on some of these larger cap tech names, especially here in the short term? What kind of changes or what kind of adjustments should they be making to their strategy, if any?
Yeah, well, look, I think the biggest challenge for investors right now isn't necessarily should they rotate more risk into the Magnificent Seven or mega cap tech. It's how to put those massive cash hoards to work that they've built, right? So you've built up over $2.5 trillion in money markets since the pandemic. T-bill ownership's off the charts. So one of the best things to do right now is look for alternatives you can embrace where you're meaningfully increasing your return without taking uncomfortable levels of risk, right? And by uncomfortable levels of risk, it was a reminder of the last 2 weeks that, you know, if you're adding risk at elevated valuations, you can walk into a meaningful correction. Who needs the volatility? If you can make high single digits or low teens, there are many democratized options now you can pursue.
Bitcoin, we got to talk about this for a hot second here. The halving taking place on Friday, the phenomenon happening roughly every 4 years, of course, the 210,000 blocks that need to be created here. I got to know, from your perspective, how much more of a tailwind that provides to some of the Bitcoin pricing now and how you're evaluating it.
Yeah, so classically, whenever you have new supply constrained, right, and demand stays constant, you get higher prices.
Right.
So, you know, Bitcoin's an incredibly cyclical asset. We'd expect more upside. The cautionary note, though, is it's unclear to everyone how much of that upside's already priced in because you had the ETF flows, the approval, the surge, and you already made new highs prior to the halving, which had never been done before. So from our perspective, we do expect further upside. However, you have to be cautious with volatility. Again, remember that term, uncomfortable levels of risk. If you can't tolerate a 10, 15, 20% drawdown, you probably shouldn't be invested in the first place. But I would be surprised if we're not at 50 to 100% over the next year.
When you talk about then that catalyst going forward, what is it going to be in order to get to those all-time highs?
So I think it's very dependent on whether ETF flows continue to be positive. Since ETF approval, it's almost been a perfect correlation. When there's flows coming in and the Wall Street marketing machine can attract new capital, Bitcoin goes up. When there's outflows, it corrects or goes the other way. So, it's very difficult to predict that, but you would think as there's more and more adoption, there will at least be enough flows to absorb new supply, and then some, which will drive price higher.
And then additionally here, when we think about some of the other ETFs that could potentially be listed this year, do you think that there's any perhaps large difference in the number of people who are willing to flow into Bitcoin or continue to flow into Bitcoin versus the ETFs that have been put forward like Ethereum or some of the other altcoins?
Yeah, I think Bitcoin's very different because it's really got institutionalized last cycle, meaning there was always the ability to attract capital away from, let's call it, the crypto community. I think when you're talking about other cryptos, for instance, Ethereum, there's a lot of debate over whether Solana is going to eat their lunch or not. You have very disappointing performance so far in this cycle. And I just don't see the same degree of institutional adoption like you have with Bitcoin. Because ultimately, Bitcoin, it's hard money. It's an inflation hedge. It's a government profligacy hedge that more and more institutions are adopting.
Troy, great to see you in person.
Great to be here as well.
Thanks for coming in studio. Troy Gayeski, who is the FS Investments Chief Market Strategist. And a programming note that also involves Troy. Yahoo Finance launched our brand new podcast, The Opening Bid, this morning, bright and early, 8 a.m. Troy Gayeski joined our executive editor, Brian Sazi, and talked all things markets and tech. Catch Opening Bid with Brian Sazi every Monday and Friday at 8 a.m. Eastern.